Business risks and management of business risks. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses business risks and the management of business risks. In this video, you will understand the meaning of risk, business risks, causes of business risks, how to identify business risks, enterprise risk management, ERM, benefits of ERM, the importance of understanding risk, types of business risks. Risk management strategy, how to evaluate risks facing businesses, business risks evaluation tools, the importance of prioritizing risks, strategies for managing business risks, and internal controls for risk prevention. What is risk? Risk is the uncertainty of financial loss. A risk is anything that may affect the achievement of an organization's objectives. It is the uncertainty that surrounds future events and outcomes. Risk is the expression of the likelihood and impact of an event with the potential to influence the achievement of an organization's objectives. Risk, uncertainty, may affect the achievement of objectives. Hence, it is beneficial for enterprises or businesses to manage their risk exposures. Business risks. Business risk is a broad category. Business risk refers to a threat to the company's ability to achieve its objectives and financial goals. It applies to any event or circumstance that has the potential to prevent you from achieving business goals or objectives. In business, risk means that a company's or an organization's plans may not turn out as initially planned or that it may not meet its target or achieve its goals. Business risk can be internal, for example, a firm's strategy, or external, for example, the global economy. All types of risks should not be managed or treated in the same way. A business organization should understand the type of risk it faces internally, within the firm, and externally, outside the firm. Risk evaluation enables a firm to determine the importance of risks to the business and decide to accept a specific risk or take action to prevent or minimize the risk. A business should not manage or treat all risks in the same way. Causes of business risks. There are basically three causes of business risk. 1. Natural causes. Natural causes of risk include flooding, earthquakes, cyclones, and other natural disasters that can lead to the loss of lives and property. For example, a delivery truck is on its way to deliver the order of a customer but is met with a cyclone along the way, causing an accident. To counter such causes, businesses need to take out comprehensive insurance coverage. 2. Human causes. Human causes of risk refer to negligence at work, strikes, work stoppages, and mismanagement. 3. Economic causes. Economic causes involve things such as rising prices of raw materials or labor costs, rising interest rates. An interest rate refers to the amount charged by a lender to a borrower for any form of debt given, generally expressed as a percentage of the principal. For borrowing, and competition. How to identify business risks. Risks are inherent to every environment and business. They cannot be avoided, hence, risk should be addressed effectively to minimize their impacts. The first step in managing risk is to identify the risks to come up with a risk management strategy. Risk management encompasses the identification, analysis, and response to risk factors that form part of the life of a business. Here are tips on how to identify business risks. 1. Analyze the sources that may trigger problems. It is important to identify and analyze the sources that can cause a problem. Risk triggers can be internal or external. 2. Act promptly. Managers should not wait for potential problems to become actual problems before they start doing something. The moment a problem is deemed to be a threat, the company's management should take appropriate steps to handle and manage the risks. 3. Involve employees. Identifying risks is not the sole responsibility of the managers and top-ranking officials. management should involve their employees in identifying the risks that they see in their respective departments and train them to handle such risks at their level. 4. Make a list of industry-specific risks. By looking into the industry where the company operates, managers will be able to identify the possible risks that the business may face. If the same risks happen to other companies in the same industry, there is a possibility that the risks or similar occurrences might be experienced within your organization. Therefore, businesses should be ready with a list of solutions or steps to address the risks. 5. Create a record of risks. Sometimes, the same risks arise over and over. By creating a record of all the risks experienced by the company since it started, management will be able to do a regular review of past events to detect patterns that may better prepare the company for future risks. Business or Enterprise Risk Management, ERM. It is essential for businesses to manage their risks effectively to ensure good performance and business growth. Business or enterprise risk management is an important business practice that helps businesses to identify, evaluate, track, and mitigate potential risks that may impact their operations and activities. Risk management is often practiced by businesses of all sizes, directly or indirectly. Though, some firms do not manage their risk effectively. Small firms often manage their risks informally, but large firms should adopt a risk management process to suit their operations. Benefits of enterprise risk management. Enterprise risk management process helps individuals and businesses to personal and business successes. Enterprise risk management also enables a business to 1. Make informed decisions, plan, and prioritize. 2. Allocate capital and resources appropriately. 3. Prevent wastage of time and effort in firefighting and addressing potential problems. 4. Discover opportunities. 5. Reduce business liability. 6. Foresee what may go wrong, preempt, prevent, or react promptly to risks, and 7. Improve outcomes for business and professional performance. Enterprise Risk Management, ERM, Framework. ERM promotes a holistic method of managing both operational and strategic risks across the organization. The ERM framework is essential regardless of the institution's size or how it wishes to categorize its risks. ERM framework will assist companies' management and boards of directors to manage risks of their organizations effectively. Sound ERM framework must address a firm's critical risk management questions. The strategic plan for ERM includes 4 enterprise-wide strategic initiatives for 1. Mitigation, 2. Preparedness, 3. Prompt emergency response, and 4. Quick business activity resumption and recovery. Importance of understanding risk. Risk is often described based on an event, a change in circumstances and the consequence of the event. In this regard, it is reasonable to view risk as to the effect of uncertainty on achieving or surpassing a firm's business objectives. This effect may be positive, negative or a deviation from the expected, for example in forecasts and projections. Without identifying risks, it is difficult to successfully define business objectives and develop strategies to achieve the organization's objectives. It is a good practice for an organization to integrate business risk management within its strategy formulation and business planning processes. Understanding and management of risks would assist a firm to control and prevent the financial, organizational, legal, and other risks associated with its operations. Types of business risks. Business risk refers to a threat to the company's ability to achieve its financial goals. In business, risk means that an organization's plans may not turn out as originally planned or that it may not meet its target or achieve its goals. Business risk is a broad category. Business risk can be internal, for example, a firm's strategy, or external, for example, the global economy. Businesses are exposed to several risks including 1. Economic risk. The economy is constantly changing as the markets fluctuate. Some positive changes are good for the economy, which lead to booming purchase environments, while negative events can reduce sales. It is important to watch changes and trends to potentially identify and plan for an economic downturn. To counteract economic risk, save as much money as possible to maintain a steady cash flow. Also, operate with a lean budget with low overhead through all economic cycles as part of a business plan. 2. Financial risk. Financial risk refers to a business ability to manage its debt and fulfill its financial obligations. This type of risk typically arises due to instabilities, losses in the financial market or movements in stock prices, currencies, interest rates, etc. The more debt a company has, the higher the potential financial risk. Financial risk is about the financial health of the company. Can the company afford to offer installment payments to its customers? How many customers can it offer such an installment scheme? Can it handle business operations when 2 or 3 of these customers are not able to make their payments on time? 3. Regulatory and compliance risk. Regulatory risk is the risk that a change in laws and regulation will significantly impact an institution. A change in laws or regulations enacted by a governmental or regulatory body can dramatically increase the costs of conducting a business, decrease the attractiveness of an investment, or change the competitive landscape. Compliance risk involves companies having to comply with new rules that are set by the government or by a regulatory body. For example, there may be a new minimum wage that must be implemented immediately. Business owners face an abundance of laws and regulations to comply with. For example, recent data protection and payment processing compliance could impact how you handle certain aspects of a firm's operations. Staying well versed in applicable local and international applicable laws can help to minimize compliance risks. If a firm relies on 1 or 2 clients for its income, the company's financial risk could be significant if one or both no longer use the company's services. Start marketing the company's services to diversify its base to ensure that the loss of one will not devastate the company's bottom line. Non-compliance may result in significant fines and penalties. Remain vigilant in tracking compliance by joining an industry organization, regularly reviewing government agency information, and seeking assistance from consultants who specializes in compliance. 4. Security and fraud risk. As more customers use online and mobile channels to share personal data, there are also greater opportunities for hacking. News stories about data breaches, identity theft and payment fraud illustrate how this type of risk is growing for businesses. Not only does this risk impact trust and reputation, but a company is also financially liable for any data breaches or fraud. To achieve effective enterprise risk management, focus on security solutions, fraud detection tools and employee and customer education about how to detect any potential issues. 5. Reputational risk. Reputational risk is the potential for negative publicity, public perception, or uncontrollable events to impact negatively on a company's reputation, thereby affecting its revenue. Reputational risk strikes without warning. It shifts a corporate landscape, impacts revenue, and sparks chaos. It can also affect customer opinions and organic traffic by weaving negative content into the search results. There has always been the risk that an unhappy customer, product failure, negative press or lawsuit can adversely impact a company's brand reputation. However, social media has amplified the speed and scope of reputation risk. Just one negative tweet or bad review can reduce a firm's customers, thereby reducing the company's revenue. To prepare for this risk, leverage reputation management strategies to regularly monitor what others are saying about the company online and offline. Be ready to respond to those comments and help address any concerns immediately. Keep quality top of mind to avoid lawsuits and product failures that can also damage the company's reputation. 6. Operational or service delivery risk. Operational risk is the possibility of business operations failing due to inefficiencies or breakdown in its internal processes, people, and systems. Human error and external events, such as regulatory changes, are a few of the common sources of such risk. Operational risk occurs within the business system or processes. For example, one of its production machines may break down when the target output has not been achieved. What will the company do if one of its machine operators has an accident during work hours? Operational risk can occur internally, externally, or involve a combination of factors. Something could unexpectedly happen that causes you to lose business continuity. That unexpected event could be a natural disaster or fire that damages or destroys a business physical asset. It might also involve a server outage caused by technical problems, people, or a power cut. Many operational risks are also people-related. An employee might make mistakes that cost time and money. Whether it is a people or process failure, these operational risks can adversely impact a business in terms of money, time, and reputation. Address each of these potential operational risks through training and a business continuity plan. Both tactics provide a way to think about what could go wrong and establish a backup system or proactive measures to ensure operations are not affected. 7. Strategic risk. Strategic risks are the potential impact of strategic decisions or of a defective or inappropriate strategy. Strategic risk constitutes a lack of responsiveness to industry or sectoral changes. Strategic risk is associated with the future or long-term planning, for example, entering new markets, and expanding existing services. Strategic risks can occur at any time. For example, a company manufacturing an anti-mosquito lotion may suddenly see a decline in its sales because people's preferences have changed, and they now want to spray mosquito repellent rather than a lotion. To deal with such risks, companies need to implement a real-time feedback system to know what their customers want. For example, more businesses are using cloud storage to protect company data and rely on remote team members to maintain operations. Automating more processes also helps to reduce people failures. 8. Political risk. Political risks are risks associated with changes that occur within a country's policies, business laws, or investment regulations. Other influential factors include international relationships and any other situation which may have an influence on the economy of a given country. Political risk is a type of risk faced by investors, corporations, and governments that political decisions, events, or conditions will significantly affect the profitability of a business actor, or the expected value of a given economic action. Political risk can be understood and managed with reasoned foresight and investment. 9. Liquidity risk. Liquidity risk occurs when an individual investor, business, or financial institution cannot meet its short-term debt obligations. Liquidity is the ability of a firm, company, or individual to pay its debts without suffering catastrophic losses. If an individual investor, business, or financial institution cannot meet its short-term debt obligations, it is experiencing liquidity risk. 10. Country risk. Multinational or international firms are susceptible to country risk. Country risk is the risk that economic, social, and political conditions and events in a foreign country will affect the current or projected financial condition or resilience of a bank. Country risk refers to the uncertainty associated with investing in a particular country, and more specifically the degree to which that uncertainty could lead to losses for investors. 11. Information and technology, IT, risks. IT risk is basically any threat to a firm's business data, critical systems, and business processes. It is the risk associated with the use, ownership, operation, involvement, influence, and adoption of IT within an organization. 12. Cybersecurity risk. Cybersecurity refers to the technologies, processes and practices designed to protect an organization's intellectual property, customer data and other sensitive information from unauthorized access by cybercriminals. The frequency and severity of cybercrime are on the rise, and there is a significant need for improved cybersecurity risk management as part of every organization's enterprise risk profile. Hence, the need for effective cybersecurity risk management. 13. Investment risk. Investment risk is the probability or likelihood of occurrence of losses relative to the expected return on any particular investment. Generally, there is always a certain level of risk involved in all kinds of investment. Management of risk is essential to ensure a good investment strategy. 14. Credit risks. Financial institutions including banks, mortgage, and finance firms are susceptible to credit risks. Credit risk is the possibility that a contractual party will fail to meet its obligations in accordance with the agreed terms. Credit risk refers to the probability of loss due to a borrower's failure to make payments on any type of debt. 15. Counterparty or default risks. Banks, hire purchase, mortgage, and finance firms are susceptible to counterparty risk. Counterparty risk is the probability that the other party in an investment, credit, or trading transaction may not fulfill its part of the deal and may default on the contractual obligations. 16. Foreign exchange or currency risks. Financial institutions, manufacturers, and importers are susceptible to foreign exchange risks. Foreign exchange risk, also known as currency risk, FX risk and exchange rate risk, refers to the losses that an international financial transaction may incur due to currency fluctuations. It arises from the change in the price of one currency in relation to another. 17. Emerging risks. Emerging risks are new risks or familiar risks that become apparent in new or unfamiliar conditions. Their sources can be natural or human, and often are both. As a new, novel, manifestation of risk, of a type that has never been experienced. Novel manifestations of risk include entirely new risk types that have not existed previously. Risk management strategy. The best way of dealing with risk would depend on the situation, the probability and impact of the risk. It is unlikely that a firm will be able to eliminate all risks, so the company's task will mainly be to determine whether the risk is acceptable and, if not, decide how you want to deal with it. How to evaluate risks facing businesses. Risk evaluation enables a firm to determine the importance of risks to the business. The organization may decide to accept a specific risk or take action to prevent or minimize the risk. First, the organization should consider all the types of risks its business might face, from strategic and compliance risks to financial and operational threats. These risks should be identified and evaluated appropriately. The company should also rank the risks by considering their likelihood of occurrence and consequences on its business and operations. For many businesses, assessing consequence and likelihood as high, medium, or low would suffice. Furthermore, an organization should evaluate its 1. Business plan, to determine which risks may affect a company's objectives, and 2. Legal requirements, costs, and investor concerns. Sometimes, the cost of reducing a potential risk may be so high that doing nothing makes more business sense. Business risks evaluation tools. Businesses can use several business tools to evaluate risks. For example, you can create a risk map by plotting on it the significance and likelihood of the risk occurring. Each risk is rated on a scale of 1 to 10, 1 to 10. If a risk is rated 10, this means a major concern to the company. 1 is the least important. The map allows you to visualize risks in relation to each other and gauge their extent. This would enable you to plan the type of controls you would put in place to reduce the risks. Importance of prioritizing risks. Prioritizing risks allows you to direct time and money towards the most important risks, i.e., those risks with the greatest potential to disrupt a business. By identifying which risks to focus on, you can put systems and controls in place to deal with any eventualities. For example, define a decision process and escalation procedures that the company would follow if an event occurred. Strategies for managing business risks. To determine the most effective risk mitigation strategy for a business, the company needs to first identify its risk exposures, analyze, and evaluate their potential likelihood and impact. When you fully understand all the possible risks and their severity, you can begin to treat them. The most common strategies for treating the risk are 1. Avoidance, 2. Reduction, 3. Transfer, 4. Acceptance, 5. Sharing. 1. Risk avoidance strategy. If the probability and the impact of the risk are too high, it may be best to remove it altogether. This might involve changing the way an organization manufactures its products or decides to avoid certain activities, for example, the launch of a new product or entering a new contract. Whether this is a viable option depends on the company's circumstances. You should note that by stopping activities associated with a risk, you may also forfeit associated potential return and opportunity. 2. Risk reduction strategy. Reducing risks involves taking measures to minimize the probability and the impact of the risk occurring. The aim is to reduce the risk to an acceptable level, sometimes called a residual risk level. Most businesses should try to reduce the risk whenever possible and be economically advantageous. For example, you could introduce new safety measures, strengthen internal control, and diversify operations to mitigate the worst risks. 3. Risk transfer strategy. Risk transfer or sharing helps you to redistribute the impact of an adverse event over multiple parties. This may include partners or company members, an outsourced entity or purchasing an insurance policy. 4. Risk acceptance or risk retention strategy. Accepting the risk assumes not taking any action to mitigate its impact and probability. This do-nothing approach accepts that some level of loss is likely to occur, usually the type of loss that can be easily absorbed within the business, at least at the beginning. However, if risk events occur regularly, business disruption and the costs for addressing it might increase. It is important to assess risk retention options alongside other possible mitigation approaches to determine a suitable approach in the long term. 5. Risk sharing strategy. Risk sharing works best for risks that are unlikely to occur, but could potentially have a big financial impact. Contracts with suppliers or contractors may provide a means to move risk away from an organization, but keep in mind that this approach may not always be suitable. For example, if a company's product is faulty due to a supplier's error, customers may still associate it with you even if its supplier pays for damages. Internal controls for risk prevention. Managing and reducing risk involves putting processes, methods, and tools in place to deal with the outcomes of events that have been identified as threats to the business. Effective internal controls are necessary to mitigate different types of risks to a business. In this regard, there are two categories of control. 1. Preventive controls, help you avoid risk before it occurs, and 2. Detective controls, help you to find the source of the problems after the occurrence. To prevent and reduce risks, it is essential to evaluate a firm's current control activities and modify them appropriately. For example, the company may decide to 1. Set aside financial reserves to ease cash flow problems if they occur. 2. Use physical control over assets, for example, locks. 3. Put in place data backup and IT support to deal with potential systems failures. 4. Screen and train employees before you allow them access to critical systems. 5. Limit the number of employees with access to critical or sensitive data. 6. Segregate certain types of duties to different employees, for example, financial decisions. 7. Introduce pre-approval of actions and transactions. 8. Carry out internal audits and inventory counts. 9. Review organizational performance regularly. Maintaining appropriate and effective internal controls will help an organization to mitigate some of its risks. Developing a risk management plan will also help a firm to foresee risks, estimate impacts and define its responses to address them. Conclusion. Business risk and how to manage business risks have been discussed in this video. Risk is the uncertainty of financial loss. A risk is anything that may affect the achievement of an organization's objectives. Business risk refers to a threat to the company's ability to achieve its objectives and financial goals. ERM promotes a holistic method of managing both operational and strategic risks across the organization. I hope the video is educative and beneficial to you. Please post your response below in the comments section. If this video has been educative and beneficial to you, Then, give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section down below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.